This is Rick Rule from Rule Investment Media. Uh, the latest in a series of interviews for sponsors around the Natural Resources Investment Symposium, July 7th through 11th in Boca Raton. We've done these pre-conference interviews for years in an attempt to make sure that our attendees make the best possible use of the time that they have at the conference. Remember, you'll have 50 hours live or in person at the conference, which is not enough time to absorb all the information that we are going to feed you. So it's important that you allocate your time intelligently. In the furtherance of that, we'd like to introduce you to all of our exhibitors and all of our speakers before the conference so that you could allocate your time most efficiently. I'm delighted today to welcome Adam Davidson from Trident Royalty. Adam, first of all, as a shareholder, thank you for your efforts on behalf of shareholders, and thank you too for your ongoing sponsorship of the Natural Resources Investment Symposium. It's a pleasure to have you with us.
Yeah, thanks so much.
Let's begin by your asset base. What I'd like to do is establish the value in the company before we talk about where it's going to go from here. Tell us something about what you own, what you're excited about, and how that forms the basis and value for Trident shareholders.
Yeah, so we've got a total of 21 assets at the moment, royalty assets within the portfolio. We're about 3.5 years old, so in pretty fast order, we built out a good portfolio. 13 of those assets are cash flowing. When we listed 3.5 years ago, we just had one single asset. One of the unique things about Trident is that our portfolio crosses sort of the breadth of the mining sector. We've got exposure to iron ore, mineral sands, but most significantly to lithium, copper, and gold, but a good spread of commodities. I won't drag you through all 21 assets, but our biggest asset on a net asset value basis is a royalty over the Thacker Pass lithium project in Nevada. And so if you step back and look at that style of asset and what it provides Trident, it's pretty staggering. I mean, we've got effectively this New Deal type of spending, rightly or wrongly, in the U.S., where billions and billions are going into various strategic initiatives, one of them being to secure the battery supply chain. The U.S. doesn't really produce any domestic lithium for all intents and purposes, but Thacker Pass has now been fully permitted and is now in construction. It's effectively the only significant lithium asset that's been permitted in the U.S. It's one of the world's largest lithium deposits. Just last month, the Department of Energy announced a $2.3 billion loan. General Motors is there as the largest shareholder and the off-taker of the lithium. They're putting in a total of $650 million. And then just last week, the operator of the asset raised $275 million. So you have this $3 billion CapEx project. It's now fully funded. It's in construction. First production slated for 2027. Now, if that was a gold royalty in Nevada, there are lots of gold royalties that would be chasing that. Being a lithium royalty in Nevada, despite the fact that it's going to spit out tens and hundreds of millions of dollars over the mine life, which is initially slated at 40 years, so it's a multi-generational asset. There's just not that much competition for it. And so that's where we see our strategic edge, is to build out a portfolio with exposure to multiple commodities in good jurisdictions that are ideally progressing clearly towards cash flow.
And using Thacker both as an asset, but also as a sort of a forum for a lesson, can you tell us something about the net present value of Thacker based on the feasibility study and the price you paid for it, and also the net present value of that relative to your enterprise value? This really goes to the value thesis.
Yeah, exactly. I mean, if I point people to analyst broker reports, many of which are public, but they place the value of our Thacker royalty at roughly our market cap, sort of 120 to 130 million US. But then on top of that, obviously, you've got 20 other assets, many of which are generating cash flow today, and a good spread of commodities. To answer your question in terms of how we were pricing this thing and how we look at value, when we initially acquired the asset, we were pricing at a 16% post-tax IRR. So a good, healthy return on an annual basis, again, as I said, for multi-decade. Now, a couple of things have happened since we made the acquisition. First, they increased the planned production profile, which, as you know, is the beauty of the royalty model. The CapEx went from $550 million at PFS to $3 billion in the most recent numbers. That means dilution for the operator. They've got to raise more equity. They've got to source that capital. but we've got the comfort that it's in construction and it's funded. So there's no risk that the project doesn't go ahead, but we don't wear any of that dilution. So we get a little over 1% of their revenue in perpetuity. The fact that they've made the project larger over time and have scaled the planned production profile, that's all to our benefit at no additional cost. So it's a phenomenal outcome. And the other thing was that we were pricing in a much lower lithium price at the time of acquisition relative to the consensus forecasts at the moment. So lithium's obviously been on a roller coaster, touched as high as almost 90,000 a ton. At the moment, delivering to China is 15,000 a ton, but delivering to Japan, Korea, more established economies is still around 30,000 a ton. But consensus is sort of 20, 21,000. We were pricing in 12,000 long-term price. So we've got an asset here that is pretty comfortably north of a 20% post-tax IRR, as I said, for multiple decades. So a pretty phenomenal asset, and underscores the strategy. If we can continue to bolt on assets like that, you can see us growing into sort of the established, diversified royalty company.
Let's talk about that. You have 20 or 21 assets now, including, if I remember your answer, 12 or 13 that are generating cash now. Tell me something about whatever durable competitive advantage you might have over the other royalty and streaming companies that are in the investment landscape. What do you do differently? How will you continue to grow?
Yeah, the biggest thing is that if you look at the mining royalty sector relative to the mining sector itself, the mining sector is roughly a third precious metals. The mining royalty sector is about 95% precious metals focused. And that's really the gap that we're looking to exploit. So we will do precious metals royalties, and we've got some exposure to it. What we don't want to do is go and compete with the sort of 20 odd gold focused royalty companies and try to outbid each other. You're just going to drive down your internal returns. We look further afield. In fact, we sold some exploration stage gold royalties to Franco-Nevada, the multi-billion-dollar behemoth in the space, for a 2.5 times return in the space of 2 years. Allowed us to recycle that capital into other acquisitions rather than needing to raise equity. But that's really the competitive advantage. As I said, if Thacker Pass was a gold royalty in Nevada, we'd be trying to outbid the likes of Franco-Nevada or Royal Gold, multi-billion-dollar companies with much lower cost of capital than us to try to secure those royalties. That's a losing game. But targeting sort of non-precious royalties by and large, and then opportunistically picking up some gold and silver exposure where we can and where it's not competitive, that's really the strategy in a nutshell. And that's what not many other parties are doing. There are a couple others that do non-precious royalties. Don't want to sort of make it sound like we're the only ones, but you can count them on one hand. And in aggregate market cap, the $75 billion mining royalty sector, a couple billion of that is non-precious focused. So the dislocation there is pretty clear.
People listening to this interview often are long-term clients of mine. They will remember Altius, so they will remember some of the joys experienced in non-precious metals royalty acquisition. One of the things in your presentation that I really liked was the part in the slide that contrasted your return on capital employed relative to the cost of capital. Sophisticated investors know that the delta between the return on capital employed and the cost of capital is where recycle ratio and hence value is created. Can you talk to us about your achieved and targeted return on capital employed relative to your cost of capital, both by way of debt and, if you choose to, equity?
Yep. Yeah, no, as you touch on, that's really the key. So for us, I use Thacker as an example. We were initially pricing in a 16% post-tax IRR, and then you hope for some of the events that ultimately did occur, commodity price ticking up, production profile increasing, or mine life extensions. So you hope to get above that. But really the arbitrage is between our cost of capital and the acquisition return. And our cost of capital, we announced a couple months ago a revolving credit facility with BMO and CIBC. So a couple of the larger Canadian banks that know the mining space, know the mining royalty space, lent to a lot of the gold-focused royalty companies. They get what we're doing, and the cost of capital there is 2.5 to 4.5% over SOFR. So you take the base interest rate plus, about 3%. It depends on net leverage ratios where you sit within that 2.5 to 4.5% range. So that's very competitive cost of capital. In fact, our bigger multi-billion-dollar peers aren't that much lower than that. So that's effectively the margin that we clip is from that rate up to our return profile. And obviously that the debt rate that I'm quoting is pre-tax, so you get some tax benefit there. So securing that revolver earlier this year allows us a couple things: increase the sort of the width of the returns that we secure when we're making these acquisitions. So if you do a deal and you're getting a 15% IRR on a post-tax basis, and your cost of debt's 6% on a post-tax basis, that's obviously the margin that we're clipping. The other thing is it allows us to be more competitive. The fact that our cost of capital has been decreasing as we've grown and the company's matured, and key assets like Thacker have been de-risked and are moving into construction. That's obviously gotten us bank support such that we can push our return profile and maintain the original spread that we were looking for. So in the early years, when we were paying a higher cost of capital, you had to demand higher returns to get that target. But now we've got a little more flexibility, which means that we can be more acquisitive in building out the portfolio.
Adam, one of the things that I really enjoyed about your presentation that I think was very investor friendly was your discussion of the difference between your return on capital employed and your cost of capital. That delta, of course, is where recycle ratio comes from and where companies are built. Could you talk about the return on capital employed as opposed to your cost of capital?
No, as you say, that's where the rubber meets the road with regards to how we actually generate value. And it's pretty simple in some respects. So we're targeting mid-teens post-tax returns, Thacker being a good example of that. And then you hope for sort of growth thereafter as mine lives are extended or plant production profiles increase or the commodity price increases. But really the spread is from that mid-teens return that we're targeting, and then our cost of capital, which happy to say that we announced a revolving credit facility just a couple months ago with BMO and CIBC. So a couple of the larger commercial Canadian banks that know this space, know the mining royalty space specifically. So they charge us SOFR, so the kind of the base interest rate plus 2.5% to 4.5%, which is a very low cost of capital. Even our very big multi-billion-dollar peers don't get much cheaper than that. So that allows us to basically clip the difference. If we're paying on a post-tax basis, say 6% cost of debt, and then we're deploying capital at 15, 16% on a post-tax basis, that 10% spread is basically what our returns are. And this is a model that the gold-focused royalty companies have proven sort of over and over. As the portfolio matures, as ours has, assets like Thacker are de-risked through permitting and then financing and now into construction, the lenders will emerge with lower and lower costs of capital, which just allows us to become more and more competitive. We can table bids that are more attractive to counterparties because our cost of capital is lower.
Finally, Adam, if our attendees would like to learn more about Trident, who might they learn it from, and how might they approach them? What's the contact's email address or phone number? How do people learn more if they would like to, and I believe they should like to, learn more about Trident?
Yeah, I'd encourage people to reach out to me. My email address is ad@tridentroyalties.com. It's also on the website and all of our other informational. So I'd encourage people to sign up for the newsletter or sort of news updates. But if they have specific questions or want to jump on a call in advance of the conference, more than happy to. And so reach out directly, ad@tridentroyalties.com.
Adam, thank you for your efforts on behalf of shareholders, myself included. Thank you, too, for your sponsorship of the Natural Resources Investment Symposium. It'll be a pleasure to see you in Boca.
Great. Thanks, Rick.